What is going on, you guys, and welcome to the video. My name is Brandon, and in this video today, I'm going to be sharing with you guys 4 investment ideas, or in particular, 4 Canadian-based index funds or ETFs, so exchange-traded funds, that are specifically focused on generating passive income. Passive income through dividends, or as we'll look at in a second, income generated from REITs or real estate products. These are some of the simplest ways for investors to generate predictable and consistent streams of passive income by simply going out and purchasing investments that spin off these quarterly or monthly dividends. I've done actually a number of videos on ETFs. If you do want to look out some other options, for example, some US options, for example, more core ETFs, but this video in particular is going to be specialized to passive income ETFs. So if you guys enjoy this video, all I ask is drop a big thumbs up. That helps the channel more than you would know. But the first ETF that I want to highlight for you guys is the ticker VDY, and it's the FTSE or FTSE Canadian High Dividend Yield Index ETF. It's very important that as we invest in these products, we understand what we're investing in, what they hold, what they do, and of course the pricing. We're going to cover all 4 of these coming up. But this one right off the bat we notice is a fund provided by the company Vanguard. This is one of the biggest producers and one of the biggest options available when it comes to index funds or ETFs. Very, very reliable option. Again, the ticker you'd be looking up is VDY. As an example here, I can show you, you can just type in basically the quote here. You typically type in VDY stock and it'll come up. But here's what the chart performance has been looking like. I want to dive into the fund because what we can see right off the bat is that this fund attempts to replicate, or seeks to track, I should say, the FTSE FTSE Canadian High Dividend Yield Index. Very simply, this is an index of Canadian companies that, as you may have guessed, produce a high dividend yield. I'm going to go ahead and link all these down below if you'd like to go ahead and take a look for yourself. But we are going to cover some very key points. For example, dividend schedule monthly. I know how much investors love this, being able to get these projected income streams month after month after month. You see that for every unit that you buy of this fund, you're going to be receiving about 9 cents. Just to actually backtrack a second, this fund trades at a net asset value, or we could just look here to keep it simple. The market price of this fund is $39.42. So as of today, if you wanted to go out and buy 1 share of the ticker VDY or the FTSE Canadian High Dividend Yield Index, you'd be paying just shy of $40 Canadian. We're going to touch on the fee in just a second. This would spin you off a monthly dividend of 9 cents per month. If we hover down to the bottom of this page, we're actually going to look at a very important characteristic. We're going to look at how many stocks this fund in particular owns. This fund in particular has 40 holdings, so we can think of this as a basket that owns 40 different companies. You have the average price to earnings ratio, you have the median market cap or size of these businesses if you'd like to go deeper into this. But what I want to go down here is actually show you the holdings exactly. You'll note here actually before we move on, market allocation. This is a Canadian focused fund. So we see 100% of the fund is invested in Canadian companies, the region being North America. And if we do scroll down to this holding details, we can see a number of the top holdings. Now you can click here to see the total 40 holdings, but what we see right off the bat is we have some great exposure to the banks, Royal Bank and TD Bank making up the biggest portion of this fund. Enbridge, which is an energy company. You have the other banks, TC Energy, Manulife, Bell Canada, Canadian National Resources, etc. And keep in mind, these are just the top 10. Again, feel free to go down and look at all the holdings so you really understand what you're buying. But this is a sector breakdown of the specific fund. And what we notice is that it is very, very concentrated in the financial sector. 60% of this fund, or 59.3%, is situated in the financial sector. And that makes sense because here in Canada, the banks pay tremendous dividends. Following that, we have the next largest sector is the energy sector at 22.6%, and then some smaller exposure to areas such as telecommunications, utilities, and basic materials. But what I'd like to point out from this fund in particular is that understand you are getting the heavy financial exposure, and you're not getting too much exposure to some other areas because they may not be as nice of sectors or industries as it pertains to dividends. Now, it's important to talk about the price of this fund because this is not a free fund to invest in, as with any index fund or ETF. And that's where you're going to come across what's called the MER, or the management expense ratio. And with this fund, you are paying 0.21% in order to invest in all of these products. So as a reminder to anybody new to index funds or ETFs, you could always go out and buy these products or these stocks all by themselves, but to have a one-stop shop or a one-stop basket of high-yielding ETFs, you're going to be paying 0.21%, meaning that if you invested $100 in this fund, which would buy you approximately 2 shares, let's call it 2 and a bit, you'd be paying 21 cents annually in dividends, so in fees, I should say. So extremely affordable and extremely cheap. You do see some lower, you do see some higher, but in general, 21 cents for every $100 invested, in my opinion, is an extremely affordable and practical fund. Now, of course, one of the key things that you may be wondering is how much does this pay you? Well, we already looked at the 9 cents per quarter, but in terms of the yield, in how much passive income you can expect based on the dollars you invest, if we scroll all the way down to this bottom of this page, which again I will have linked below for you guys, the trailing 12-month yield was up at 4.07%. Trailing 12 months, meaning the last year, was the yield that you would have received. The distribution as of April 30th, 2021 is 2.84%. So still a very attractive yield. This is just simply due to how certain stocks have done well. In fact, if you look at this fund, it's really done well coming out of the COVID pandemic. And as the price of this fund goes up and as the price of stocks get higher and higher, our yields do correspondingly drop down. But with the ticker VDI, you'll be looking at a 2.84% yield. I'd like to switch on now to the second fund, which is a simple alternative. And I'm starting with 2 very close comparables. This is a very similar fund, but it's offered by the company BlackRock. And in this case, the fund is XIC. So this is the ticker you'd be punching in, ticker XIC. And this is the iShares S&P TSX Composite High Dividend Index ETF. So a very similar fund, but brought to you by another provider. Now, certain investors choose a certain provider such as Vanguard or BlackRock. They're all quite comparable in my opinion, especially when you're looking at the big top dogs and you don't have much to worry about. It's more about selecting which fund that you like for you. This fund, as we can see, does trade at a net asset value, or we could call this the cost of this fund, at $23.25. Now, don't get that confused. That does not mean that this is a cheaper fund per se than Vanguard, because this one trades at $40. This is just simply the price that you pay. And we're going to take a look at the yield in a second, which will explain this to you. But very simply, this fund pays monthly dividends. It's extremely low cost, and it seeks to track capital growth by replicating the performance of the S&P TSX High Dividend Index. So this is actually a slightly different index. This one tracks the FTSE High Dividend Index, so FTCS. This one's actually just tracking the S&P TSX Composite Index. So minor details there, but we will actually see if we scroll down to the holdings, you will actually notice there's a slight difference in these funds. This fund, for example, has 74 holdings based on the index that it's tracking versus the Vanguard fund had 40. So we could call the Vanguard fund more concentrated. This one is actually more spread out or more diverse, you could call it. You will notice, however, that if we do go down into the holdings, you do see an extremely similar picture. And in this Canadian market, you're going to see heavy exposure to the financials. Again, the top 2 holdings are TD and Royal Bank, but a smaller weighting. These are only 5%. Bell Canada comes in at the 3rd largest weighting, followed by some energy companies. And you can obviously read the rest here if you'd like by toggling to the All Holdings tab. If we go to the exposure breakdown, this is a key point to acknowledge. And these are the types of things you have to look at when you're assessing ETFs. This fund definitely has high exposure to financials, but a much more even weighting across a number of sectors. So if we backtrack to this just for a moment, so I hope I'm not going too fast for everybody, but here we look at, it was a clearly condensed fund in the financial sector with 60% of the fund in financials, and then it totally drops off. Well, in this fund, the exposure is a little more balanced. You actually have a higher weighting to energy and a significantly higher weighting to communications or telecom and utilities. You even have actually exposure going further down the list versus this one was actually quite a significant drop off with no exposure to some of these other sectors. So this I would consider a more diverse fund. If you're the type of investor that's not trying to concentrate everything in one spot, this could be a great comparable, because when we look at the price of this fund, it's almost identical. You're paying let's just call it an exact same MER. Again, I like to think of these as basically mirror image products just brought to you by 2 different providers. The management fee on this is 0.22%, meaning for every $100 that you invest in this fund, you'd be paying 22 cents. So a cent different in the two. Again, don't get too caught up on that because those are very, very comparable. But in terms of the yield, I'm going to scroll up here and bear with me as I come here. So very similar story. The trailing yield was absolutely higher. Over the past 12 months, this fund distributed 4.46% in dividends. In other words, if you invested $100 in this fund throughout the calendar year or on an annual basis, you'd earn $4.46. Obviously, if you want to scale that number up, you can. I believe I mentioned already that this is a monthly fund, but the distribution yield here as of May 21st is currently higher. So 3.92% versus the other one that we just looked at, VDY, this was sitting at, I believe, 2.84%. So you're actually earning about a percentage point higher in distribution yield, and that would just be simply due to the characteristics of this fund. You have more holdings, and based on the way they are weighted and the particular stocks that are owned in proportion, that's simply the case of it. So we could say that as of today, as of filming this video on May 24th, this is always subject to change, for a very similar price, you are looking at a nicer yield on the ticker XEI. So those are two fund comparables. You can also see that this fund just up to date, year to date, was up 21%. Again, the markets have done extremely well, but this is the stock quote that we're looking at. Let's move on to another fun one, and we're going to be changing up the pace here because we're going into the real estate investment trust market. That's exactly what this word right here stands for, or this acronym, I should say, a REIT. And the ticker that you're going to be looking at is a very popular option here in Canada. It's the ticker VRE. This is another fund that is brought to you by Vanguard, and this is a fund that specifically invests in the real estate investment trust market. And as we can see by the objective here, Vanguard FTSE Canadian Cap REIT Index ETF seeks to track to the extent reasonably possible before fees and expenses the performance of the broad Canadian real estate equity index. We're going to scroll down and I'll show you exactly what I mean here, because this basket in particular, you can see that it's a far more condensed basket. In fact, it only owns 15 companies, or 15 REITs, I should say. And if we scroll down into our region exposure, we see an entire weighting to North America. Again, this is focused on the Canadian market, 100% weighted to Canada. But the holdings in this funds are not individual stocks, so not the Teluses and not the Bells and the TD banks. These are actually independent real estate investment trusts. And you can think of these as little baskets in and of themselves that own a variety of different exposure to real estate. So how cool is it that you can go out and buy an ETF like this and start getting exposure to office buildings, to residential units, to all sorts of real estate across the country where they are pulling in revenue, they're pulling in rent and lease money, and that's getting passed straight through to you as a shareholder of this fund, or I could say a unit holder. What you'll notice is if I do just scroll up a little bit, we can actually see the weighted exposure in terms of the equities, and this breaks it down into the different areas or the different spaces that this fund gives you exposure to. And as you can see, you're getting a heaviest exposure into retail REITs. So these would literally be retail in terms of like a shopping mall, something of those sorts, because those are one of the most popular ways of generating real estate income in our world. You have office spaces coming in at the second largest weighting. So commercial buildings and places where people come to work and operate out of. Right next to that, with a very similar weighting, just a percentage shy, you have real estate services, along with residential REITs, another percent shy. So these are all actually very evenly weighted. Residential REITs obviously being like homes that people rent out, diversified REIT products, industrial REIT products, and a real estate holding and development. This to me is such a cool way to get exposure to this. And as we'll look at in a second, we are actually pulling in some really nice yields from this fund. REITs are absolutely known to be paying phenomenal dividends. And if I scroll down to the bottom of this page, you'll see exactly what I mean. While we're here, we can take a look at the price of this fund. Today it's trading at $33.85, we can call it. Again, these are all in Canadian dollars. But as we scroll down to the very bottom here, we have the distributions. Again, you're getting the passive income on a monthly scale, so paychecks coming into your portfolio every single month. And the current distribution yield that we're looking at as of April 30th sits at 3.14%. So on $100 invested, you would be generating $3.14 each and every year obviously scale that number up with a more appropriate number for yourself. But this is exactly what you're looking at. If you were to type in VRE stock, this is again my favorite way of looking at it. You can take a look at the performance of this fund. Majority of people would actually invest in this fund for the income, not so much the capital appreciation, which is why a lot of these stocks tend to kind of tread water and trade between a range. But in terms of pricing, which I have not covered yet on this stock, you are getting a little bit more pricey on the MER. So the annual fee that you're paying, it's 0.38%, 38 cents on every $100 invested. Still extremely cheap in the big scheme of things. But this is typically what you come into when you are getting into more of a specialized fund and they get more concentrated in a specific area. You do see these management fees tick up. But amongst the Canadian market, ticker VRE is definitely a choice that I think should be taken into consideration, especially if you're one of those investors who doesn't want to put the huge down payments down. You don't want to go out and invest in real estate yourself, or maybe don't have that capability. Well, this is going to give you that great exposure within your portfolio. The share price again today that you'd be paying is $33.85. Let's move on to our final selection here, and this is a fun one. This is one produced by BMO. So Bank of Montreal absolutely has their own suites of funds. We can think of it very much like a Vanguard or very much like a BlackRock. The product that I'd be talking to you guys about today is the ticker VWC. It's the BMO Canadian High Dividend Covered Call ETF. Now, this name may throw you for a loop, but very simply, this is a fund that generates income through using covered calls. And we'll go ahead and explain this in just a second. Again, these will all be linked down below if you would like to check them out and dig a little bit deeper. But as we can see in the overview of this page, this is a fund that does pay monthly dividends. I'll knock that out right out of the way. And take a look at this yield. If this doesn't get you excited, I don't know what will. Annualized distribution yield of 7.31%. Now, a brief word on the strategy behind this ETF. And again, you can go ahead and read this, but I'll just kind of explain to you on a base level what a covered call is. This fund essentially utilizes what's called a covered call. This is a type of option, actually a very conservative type of option. When you hear about options in the stock market, everyone tends to think very speculative. You tend to think very risky. And unfortunately, that's how most investors approach options. They take it as a means of gambling in the stock market. This fund is, I'd say, the exact opposite of that, because a covered call, when you write a covered call, you essentially collect a premium. You're taking one side of an agreement that you will have to sell your stocks to somebody if they are called away at a specific time for a specific price. So in this case, BMO owns a number of different stocks in this ETF. And actually, I'll show you this, for example. If you go to the holdings tab, what we can see is they own 86 holdings, and you're going to recognize a lot of these names. Again, some of the big major companies here in the Canadian market. Now, how the covered call works is, let's assume they write a covered call on TD Bank. That actually gives the counterparty or somebody else the option to call away these stocks at a specific price if they feel they want to, or if they decide to exercise that call. Now, whether that happens or not, this fund, or the BMO ticker, we can call it VWC, for every covered call they write, they actually collect a premium. It's not free to have that right, or to be on the other side of this contract or this call option. They actually have to pay in order to have the right to call away these shares of TD Bank or Royal Bank or BCE, etc., etc. So as part of this unique fund's strategy, they are essentially collecting these premiums that other people, the other counterparties, are paying. They may actually call some of these stocks away. So absolutely, there will be cases where the stocks do get called away as per the terms of the contract. But there will also be many times where that doesn't happen. And regardless of the outcome, this fund is collecting premium after premium after premium, and they're able to spin that off and pay us some amazing, amazing dividends. Like I said, today we are sitting at, if we move back to here, actually we can go taxes and distributions. We can see that for every share that you own of this fund, they are paying out a distribution of 11 cents. And the price that we'd be paying for this fund today is sitting at $18.10. Excuse me there. $18.10. So actually a very high and nice yield on this. Again, to highlight, we're looking at a 7.31% dividend yield. In terms of the pricing for this fund, you will notice that we do get a little bit higher. Again, much more unique fund. We're sitting today at a management expense ratio of 0.72%. On $100 invested, you'd be paying 72 cents in fees. So in general, still to pay under $1 in fees for every $100 you invest, Very, very low cost. And I'd just like to reiterate that although this fund may sound risky to the novice investor because it involves options, this is actually a medium risk fund. A covered call, again, is actually a very conservative type of option because you already own the stocks, you're collecting premiums, and yes, they may get called away from you, but in general, this is actually a very fascinating and unique and actually very safe way of generating additional income into one's portfolio. So as you can see, here's the ticker VWC. It's the BMO Canadian High Dividend Covered Call ETF with the 7% yield. And that will wrap it up for 4 ideas that I can share with you guys for anyone that is specifically focused on passive income right here in Canada. As always be sure to do your own research and due diligence when it comes to selecting investments. But personally for me, these are all funds that I vetted and I would feel completely comfortable investing in if I was either an index fund investor or if I just wanted to section off a portion of my portfolio towards generating additional passive income. And I opted for the route of selecting ETFs or index funds. I'd love to hear from you guys what you thought of my selections today. And also if you own any ETFs that are specifically catered to passive income in Canada, share them down below. The other viewers will be happy to hear from you, and I'm very curious to know what funds you are watching or investing in. If you enjoyed today's video and you found it at all helpful, take a moment to drop a big thumbs up on this video because that is such a great way of supporting myself and the channel. If you're not already subscribed, hit that subscribe button, and we do always have our Investing Academy. If you're new to the stock market and you need courses and training to understand this on a deeper level, or you need help building your portfolio, or going through the entire process A to Z, that's exactly what we're here for. We work with people all across the country, taking them from ground zero, step zero, all the way through to automating their entire process. If you're already currently investing, you can also consider joining our private membership group. For $19.95 per month, you can get insights into our trade ideas, take a look under the hood at our portfolio, get access to a variety of other tools. There's really so much that comes with it, and that can all be found through our Investing Academy, which is that first link down in the description below. But as always, guys, I thank you for watching. I really hope you enjoyed today's video, and I'll see you in the next one.